Hey, this is Matt, and today we're going to show you our entire backtest playlist, starting with the introduction. And I've put minutes here so you could skip forward if you've already heard some of these. You get the quick start video, the backtest basics start at 5:58. We show you additional parameters at 12:22 and advanced additional parameters at 18:06. Exit rules are introduced at 23:50 minutes into the recording. You could show multiple symbols in your strategies and combining those strategies. It's a popular item there at 29:16. Legg relationships, we break down an iron condor, how to really control that at 32:53. Features that we've added, we break down and then show you another new feature, long stock and short stock strategies that you could look at alone or combined. And then we'll be adding more at the end here. Hey, this is Matt, and today we're going to look at a quick start of the backtester, signing in, running a test, and seeing the results. So when you go to wheel.orats.com, you'll be asked for a login. Go do that. Type in your email address, and it'll say that it sent you a link. Go to your email, click on the link that we sent you, and it will send you to a sheet that shows you the backtester. And when you get to wheel.orats.com, you'll see a blank screen here. This is where when you start running your backtest, you'll see them. You'll see on the left backtest or a scan. The scan is a different product. You see your email, and this is where you could log out or see what email you're using. So we're at backtest, and so let's create a new backtest. And you could see here that we're on the free pan, so we only get IBM as a symbol. So normally you could enter other symbols here if you go to upgrade. And we'll talk about these other types of more complicated and complex and powerful things you could do with multiple symbols and weightings and exit and entry signals in a different email. You could click a strategy. Here we're already on long call, and you could set all these days to expiration. But why don't we just go ahead and submit this with the default parameters? And what will happen is in a moment it will start to process this backtest, and it takes a minute. And while that's processing, we could go and create another one. So again, it's IBM. Let's try a different strategy. Now there are a whole host of strategies that you could do here, and there's also a way to combine different strategies, so it's almost an infinite number of strategies that you can do. Again, combining will be in a different video. So let's do a short call spread. So the short call spread goes in, and it automatically sets up your days to expiration, the short call days to expiration, and the long call days to expiration. So let's go. You could also do strike selection. So strike selection, you could choose either absolute delta or stock out of the money percentage, and it's explained in each one of the parameters above. So these are the deltas, so 30 delta, and we set a min-max of 20 to 50, so we'll be sure to get that or find that in any particular day during this expiration. So what this is basically setting up is a historical scanner to simulate a trade, and then you trade. The way it works is that you'll trade, and then when you exit, whether it's an expiration or an exit date, you'll roll into a new trade. So, and then you could set a date range. We go back to 2007 in ours, and it updates to the latest day here. And then there are additional things, and then we'll get into each one of these in different videos. But this being a quick start, let's go and go back to backtest here and take a look at what a backtest result looks like. So in this particular result, just buying a long call, and then it also shows all of the inputs that you did. So it's a 30 delta long call. You see that you lost money, and this is the annualized return over the life of the backtest. So for example, and then we show you the graph of the backtest. So, it's slightly negative for IBM. And you can see here, how the strategy performed. Sharp ratios, max drawdowns. Again, we're going to explain these in subsequent videos, but there's quite a bit of statistical information. Also, there's some monthly returns, so we show you how backtest performed in each month and in each year. And we also show the Sharp for each year. And then we show each trade. So that's kind of nice. So you could see what the trades are, and you could also download those results. So that's what we wanted to accomplish today: signing in, running a test, and looking at the results. So if you like this, subscribe. You can see the videos as they come out, and thanks for watching. Hi, this is Matt, and today I'd like to explain some of the additional parameters in the ORATS backtester. So let's set up a trade. Let's do Apple, and let's do a short put spread. Days to expiration we'll leave here, but you can see the short put and long put. Short put at a 30 delta, long put at a 15 delta. And the date range is the entire date range that's there by default. So entry days is how to stagger your trade. So if we're trading every 30 days, we might do a percentage of that. So we might trade every week and try to smooth out the results. So in case the stock would move and the put spread would be out of the range of the stock price where we entered it, it might be good to stagger this trade. So that's what staggering is good for. So this will trade every 5 days. IV rank is where Apple volatility is currently, or in the backtest, that day that we're simulating a trade is vis-a-vis a 1 year range. So if the 1 year high, 1 year low, what number is that? So it looks something like a range from 0 to 100. So let's put in here, since we're selling, we want the volatility to be somewhat high. So let's say 30, and then maybe not at its maximum, so 30 to 90. Spread yield percent, that's one of my favorite. It's where the absolute entry price divided by the stock price is, and you could set what that is. So for credits, it's going to be negative. So in this particular case, this is a credit, and so we'll set this kind of wide until we could figure out from the backtest. We'll go look actually at the average trades and then try to hone it down. But let's start with this. Let's start trying to only pay 1%. So 0.01. We'll set a minimum of, pretty wide, like I said, negative 0.03 and a maximum of 0. The spread price, again, we'll take a look at the backtest results, and then we'll come and maybe put parameters around the spread price. Spread delta, for example, we know that this delta is approximately 15, so maybe what we might do is say, well, 0.15 is around where we want, so let's make that a little bit tighter. So let's make it 0.1 to 0.2. So that'll be our spread delta, the difference in the two legs. Hedge, do we want to delta hedge this? So let's put, yes, we want to delta hedge that every day. So if the delta goes up, we'll hedge it. Another way to do it is through hedge tolerance, saying that if it gets to a 10 delta, then hedge. So that's an interesting way to look at it as well. Again, I'm just going over these quickly. We'll go into these in much greater detail in future videos. Market width ratio, that will help protect you in case there's a very wide bid-ask spread. So for the case of Apple, that bid-ask spread, the maximum that you'd want is probably something like 0.5%. So let's put that in as a max. Similarly, the absolute CP diff, I know that sounds complicated, but it's a call put parity. If that gets off by a percentage, then we'll want to not trade on that day. Again, you could put 0.005 for a liquid stock, maybe 2% for an illiquid stock. The implied bid volatility and the implied ask volatility. So if it's a very wild stock, you might want to set a higher number on that particular reading. The bid and ask, so maybe you might not want to trade anywhere that there's no bid, in which case you might put 0.05 and 0.05 here. And expiration types, we're going to use all, but that could be not using the week, or only using the weeklies, only using the monthlies, or using all of them. Contract size, you could say how big these contracts would be. Stock position, whether you want to put an overlay, which is always having a stock position on, or married, which marries to the actual option, so it only is there when it's married to the option. And this is the intradays to earnings. So if we don't want to trade during earnings, we don't want to sell this put spread during earnings, then we'll say, the minimum that we want is maybe 20 days. And then what we'll do, and we'll want to get out at least 1 day before earnings. So let's send that and see how the result is. Okay, the short put spread has run, and let's take a look at the results. So here are the results, slightly positive annualized return, and you could see each month. Some months we aren't in there for various reasons related to the settings that we put in. And what we'll also look at is and we'll get into this to greater detail later, but the trades. And then of course you could download this, download these results and trades, and then start to refine some of your spread yield percentages or spread prices and get the exact options, or closest to the exact ones that you wish. So we'll leave it there for now, and we'll come back with some more detail on exits and additional entries later. If you like the video, please hit like, please subscribe, and we'll see you next time. Hey, this is Matt, and today we're going to continue with the additional parameters, this time getting a little bit deeper into what some of the processes are for a little bit more advanced and how you might use the backtester. So we found in our last backtest that we have an annualized return of 0.45, and we also noticed that it wasn't in the market sometimes. So let's go ahead and what you could do is edit what you've done here. So when you edit, you could go in. So let's change the IV rank. Firstly, let's just take that out. Instead of trading only on these days, let's see if that was helpful or not. So let's submit that and see how that see what the results are for that. So we'll be comparing results. And while that's processing, again, it takes 1 or 2 minutes. Let's go and click on it, and let's edit something else out. Let's take out the hedge days. It's often you may not be delta hedging, so let's take a look at what the results are when we don't have delta hedging. All right, these tests have finished running, and let's check them out. It looks like neither of them has done as well as the initial one, but let's check out what we have. So if you recall, on the first one, we took out the IV rank, so our intuition of setting a higher IV rank did perform well. And so let's go back to backtest, and let's look at this one, which is worse as well. This had the same IV rank, but we took off the hedging. So the hedging actually smoothed out returns, and it looks like you, especially in 2018 when the market was quite volatile, it cost you a lot more during those times. So the hedging definitely helped on the short put spread. Another thing is when we download the trades, let's go and click on that and see how this looks. So the strategy summary, you could look at that, but the trades are in the folder here. And now we could go and look at what the average price is for this particular trade. So you're going to have to set up a formula, and the way you do it was with an if-then statement. So if the leg 1 equals 1, show me what the price of the option is. So it would be this cell minus that cell. Otherwise, just make it blank. So that's $1.70. And so you can see that, or you can't see, but the average of this is, so that's 248. So that's about 1% or 10%, I should say. So it's about 1%. So let's use those to train our backtester. So let's go back to the backtester, keeping in mind that it's about 1%. And so let's pivot on that. So what I mean by that is let's look at this spread yield percent. Well, trades that have more premium. So we maybe between 2 and 3%. So negative 0.02 since we're selling, and 2.5% would be our average on that. So let's try that. And then also we will try setting this, we'll edit that, and let's do the lower one. So let's go between 1% and 0, the target of 1.5%. And let's see if we get, sorry, that has to be between those, or it wouldn't let me send. Sometimes when you see the submit button grayed out, that's why. So let's see how those two backtests do. So the two backtests are back where we changed the spread yield. It looks like both of them did not perform as well as the original 0.45. So let's take a closer look. So here is the one that was about 1% or 0.5% on average, and that did not trade well. Negative per day average. So so that one wasn't. It's intuitively you're taking less spread yield. So let's look at the other, and even that performed worse, which is interesting, right? So why did that perform worse? They should add up to about the same. Well, the reason is because this was not in the market that many times. However, if you look at the what I like to look at is the P&L percentage per day. So that's 28 basis points. So let's compare that 28 basis points to the test that was in all the time. And the test that was in all the time was 18 basis points. So we'll wrap it up there, but that's showing that one of the ways to improve this test is to increase the spread yield percentage. You won't trade as much, but your per trade and your daily per trade average will be higher. If you like this, please like it and please subscribe, and we'll see you next time. Thanks. Hey, this is Matt, and today we're going to look at exiting rules using the backtester. I've run a couple tests here that we can edit and look at the exit rules. Let's start with a long put. And we could edit that so there are no exit rules yet. One of the things that you might want to think about with a long put is exiting early after the market's already gone down. You could get out and roll out. So let's do 2, and notice that it's 2.0 represents 200%. So let's do 2.0 and see how that looks. Also, why don't we look at a short put spread while that one's running. Again, it takes about a minute for those to run. So a put spread is important because we could look at exiting on a spread delta. This particular put spread is about a 15 delta. So let's look at what happens if we exit on when the delta goes up to 50 delta. So let's submit that and see how that looks. So the put spread is back, and that did improve the results over the 269, now 296. So what this is doing is it's getting out early. Now let's look at what happened with the long put. So it returned and actually improved the results a little bit here. Try something else here. Let's exit on a strike trigger, and that strike trigger can be either delta or out of the money percentage. So this is a 15 delta put, so we might try to get out if it goes above, for example, a 40 delta. and we can run that. And then let's go back and look at some exits for a put spread here. So here's our put spread. Let's edit that. So we've gone through the first 3. Now exit on strike difference. This is an interesting one. When the trade price divided by the difference in stock prices. So I like this one. So you might get out when the difference is 80%. So you've already made it's already gone up 80%, or there's only maybe 10% lost or left in the spread. So let's submit that and see how that affects the tests. All right, while these are running, let's look at another exit strategy that we might implement. So I'm back to that long put, and there's something called exit hold days. So exit after you've held this for a certain amount of days. Now this is a 300-day ideal or target. So let's just say we exited after 150 days. So that was exiting after hold days, and then there's also days to expiration. The difference is if you get in with 300 days, you've held it for 150 days. Whereas what we might do here is this, we're going to get out when the days to expiration equal, let's just say 90. So that is how many days are left in the test. So we'll take a look at that particular exit rule. Okay, for the last 2 exit rules, we'll take a look at the Apple put spread, and we'll see that exit with a certain spread price. So if there's only let's just say 10 cents left in the spread, we could exit it there. And then the last one is exit with a certain business days to earnings. So what we can do there is we could say, well, I don't want to be in at earnings, so exit the day before earnings, and I could send that as an exit. So we'll submit those, and we'll take a look at how all of these performed. The other exits that we use, look reasonable within here. So let's review. So we've gone over all of the exit rules. Exit on profit and loss. We exited when we made 200% on our money here on the put. We exited the spread delta. We exited on a strike trigger when a particular one of the legs, we could control all of them, hit a certain out of the money percentage or delta. Strike difference, when a strike difference is say 10, you could get out at 10% as that has gone by, or at 80% or 90% has gone by. Hold days, exiting when you've held a position for a certain amount of time, or exit on days to expiration is how many days are actually left until expiration. Exiting on spread price is the spread price of the entire legs netted out, and you get out at a certain price. And then exit business days before earning. In this case, we wanted to avoid earnings, so we got out before. All right, so I hope this helps. Please like and subscribe, and we'll see you next time. Hey, this is Matt, and today we're going to look at symbols and entering multiple symbols, and then also combining strategies. And now in the new backtester, we could combine multiple strategies. So let's look at the various options. One, you could type in any symbol you want here. That's a single symbol. Now, if I type a comma, then it automatically enters a new row. So I could type in SPY, comma, IWM, comma, and QQQ. And it gives me the calculated equal weightings. I'll set it off. Now create new. So let's look at, so that's, you could also just paste this right in if you have a lot of them. And it puts all 4 of them in there. Or I could set my own weighting. So let's say you have a portfolio. You could set your own weightings here and input those there. Send that off. And then a really neat other way you could do it is to paste a entry and exit with multiple symbols. So you might have various technical indicators, and so now if I were to copy that and paste it in, it then automatically weights that. And it also puts all the dates in there, so I could see the signals for that particular strategy. So that's a real neat feature. So let's submit that. Okay, the results are back, and we have the QQQ, IWM, and SPY equal weighted long call. Again, this is 30 delta call. It's about 1% a year. The Netflix and Apple one returned quite a bit better. But a really neat thing you could do now is you could combine these two. So you could combine the Qs with the long call, and you could do it either 100% to 100%, or you could do it in different, like, so I could do a 1 there and only 50% here, and then submit that, and then the backtester will go ahead and combine those. Another thing that we could do is we could add a long put. So here's a SPY long put that we might want to add to that particular strategy, and so we might do something like 100% on this, and maybe 150% on long puts. So we'll do more long puts to get more protection during those bad years. So it's complete now, and we could see that the combination of the Apple Netflix one has a higher return, and we could now look at the long call. We could see how that did in 2008. And in other months, actually made money in 2008. 13 with a 1.46 sharp, and then we could go back, and the long put really doesn't help it out much with the sharp, but it should add some to the 2008 returns, and so it does. So you get the picture. I think that you can add long puts to various portfolios here and be able to simulate those trades historically. It's a powerful feature of the ORAT's backtesters. If you like this, give us a like and subscribe, and we'll see you next time. Hey, this is Matt, and today we want to look at Legg relationships and setting those up for strike, days to expiration, and deltas. So let's go set up a iron condor, because that has the most legs. So we'll choose iron condor here, and we're automatically set up as all the days to expiration are equal, and we've already automatically set up 30 delta and 10 deltas. So let's go all the way down here and set up a DTE, or days to expiration. So usually you wouldn't set these, but let's set where the leg 1 minus leg 2. So let's create some type of a diagonal here. So we'll have a minimum of 15 and a maximum of 45 days for the wings, so to speak. So they'll be farther out. So it'll be like having 2 calendars. So we could set those up. The delta total, so leg 1 minus leg 2 delta. Right now, leg 1 is 15 delta minus leg 2, so it's a negative 15. So we might say negative 0.1 to negative 0.2 is where it's going to be. You may not want to do that for the middle part, but the outside legs, again, the leg 3 delta is a negative 15, so it's positive 15 minus put, so it's long again, so now it's the other way, so it's 0.1 to 0.2. And then the last thing that we have available is the strike width. So you could set how wide you want the strikes to be. So 2 is the default, so let's have it 4, and we don't want to be wider than 10, let's say, on that. And then leg 3 and 4 is the put versus put. So again, we'll do 4 and 10. And now I've noticed that the submit button is grayed out, so there must be an error in one of my inputs. So let's look back. So this one looks fine. Let's look at this one. Oh, there's a red here, and it says min must be met. So I have my min maxes set up wrong. So let's go negative 0.2 to negative 0.1. And now the submit button's there, and we could go ahead and send this and run the tests. So that's a good way to see if your inputs are good. Thanks. Hey, this is Matt, and today we're going to look at the list of the new features in the Backtester from ORATs. So first you can see that there's a new input area. We've made it to be much more interactive, and we've put a lot more examples here. So let's enter a symbol. We'll do SPY. And let's go to do sell a strangle, and we'll use the default values for the target. And one of the interesting things that you could do is you can use both delta and out of the money percentage. So the put, we might choose to do 0.97 or 3% out of the money, so 0.96 and 0.98. And then we've added the ability to hedge either on days other than one, and hedge tolerance. So one of the things I like to do is if the delta gets below or above a certain amount, so let's just say 0.2, like 20 delta or negative 20 delta or positive 20 delta. So if this goes up, if this strangle goes up, you'll be getting shorter. So you would then flatten your deltas out. That's called delta hedging. And another thing that you could do in here is you could do a stock position. You could do an overlay. So let's just say we would want to do an overlay, and we want to be long the overlay. We could be long or short contemporaneously with the position. That is all of the features that's related to this particular strategy. So let's send the strategy off and open a new strategy for some of the other features. So while that's processing, let's look at some other features. Another one of the features, in addition to using your own weighted symbols, you can enter a data set with symbol, entry date, exit date, and that will control when you trade. So for example, you can press Control C and then paste this directly into the symbols box, and it will get the number of symbols for each symbol that we have down here. So you could figure out a technical indicator or what have you there. You could also just put your weightings of a portfolio that you might have in there, and that's what we'll do for this. And I want to show let's do a long call spread. And one of the other features that we have here is exiting on strike difference. So if a spread has a width of say $10 and you want to get out, if it goes below $1, the value, or above maybe $9, so let's put that. So 0.1 would be 1 divided by 10, and 0.9 would be 9 divided by 10. So you could exit based on where you are and the value of the spread divided by the spread width. So that's a new feature that we have of the Backtester. And also, we explain scoring in a blog, but let me try to explain it a little bit here. For example, if we want this long call spread to be only about a 1%, so 0.005 to 0.02, and we want to find the best spreads that match all the criteria here, our delta range, so our deltas and our days to expiration. We will, because there'll be multiple expirations that might meet this, so how do you choose? Well, the way that we choose is we pick the one is the closest to each reading, our ideal. So we have a target, and then we have a spread, a min and max spread. So we score each one based on how far away you are from your target based on the min max spread. So the scoring. So now the options that you find are a lot closer to hopefully the rules that you put in there. So let's send this backtest off and show you some other improvements that we have. So one of the other improvements that we have is the ability to combine tests, even combining other combined tests within their own right. So there's an Apple, Netflix, and Microsoft long call, and a SPY covered combo. We could combine both of those strategies and in various weights. So maybe we'll do 100% of this and maybe 150% of the covered combo, and see how that particular test comes out. And then finally, the thing that I'd like to show is how the trades look now that we've augmented them for stock. So we carry through what the stock position is, and we're able to show how well the hedging has done for the stock. So this particular stock is an overlay, so we just put it on at the beginning and exit at the end, and you have a certain profit. Other times when we have a delta hedge, we'll show you each stock trade that we make. All right, so those are the enhancements that we've made in the new Backtester. Please try it out. Let us know how you like it, and if you have any ideas for further enhancements, we'd love to hear about them. Please like and subscribe. Support us on Twitter as well, and thanks. Hey, this is Matt, and today I'd like to introduce our new long stock and short stock strategies that you could use to see how well stocks do, and also to combine with option strategies. So let's go to a new backtest. We will create it, and I'll do it in SPY. And we could go to drop down here to long stock and SPY, and you can run that. And then one of the things that we'll do as well is we'll test it against a SPY short call, so SPY, and we'll go to a short call and just run it with the default settings. And then just to check our work, we can then go to a SPY and do a buy right. So let's go do that, and because that's what I'm going to be recreating here, and again with the default settings. And then as these complete, we could then combine these two strategies. Okay, now that the tests have come back, we see that SPY long stock is complete, and it has an annual return of 9.72. The short call is 0.18, and you can see that adding those two together get 9.9 of the buy right. So let's combine these strategies, and you can see if you click next to these, the combine comes up, and we'll combine it in 1-to-1 ratio, just like you would do 100 shares of stock and one short call. Okay, that's complete, and we see that at 9.9 that exactly matches the buy right, so that's good. All right, so just to review, we looked at the new long stock, and also short stock is available, and then combining that with a short call to simulate your buy right. What this will actually do, though, is give you some more flexibility into putting different weightings, like you could double that short call or half that short call, and also you can do a portfolio, multiple long stocks or short stocks together. So thanks a lot for listening. Please like and subscribe if you can. Thanks.